What's going on, traders? Welcome back to my YouTube channel. So today we're going to be going over a very important topic. I constantly get questions in the comment section under the videos. Rox, how do you know when to go for a 1 to 3 risk reward ratio trade? Do you always go for 1 to 3 risk reward ratio? When shall I change it? Maybe if circumstances differ, etc, etc. So I thought I'll hit the nail on the head today, provide you the answers that you're looking for, because ultimately risk to reward is one of the most important factors or confluences, I'd like to say, to add to your trading arsenal to give you a higher probability of becoming successful and consistent. So we're going to go over a few examples here on the charts. I'm also going to share with you some statistics, and I'm just going to give you an analogy that you can think about as you continue with your trading journey. So let's head over to the charts and let's see what's happening. Okay, traders, so we're now at the charts. Now you probably can see in front of you 3 different boxes here with some funny digits in them. Now, for most of you, you probably know what this is, but for those that don't, what I'm trying to illustrate here is our risk, which is in pink, and our reward, which is in green. Now, our first example resembles a 1-to-1 risk to reward ratio, a 1-to-2 risk to reward ratio, and number 3 represents a 1-to-3 risk to reward ratio. What that simply means is if you risk £1 or $1 or €1 and you hit your take profit, your reward will be £1, $1 or €1. If you risk €1, £1 or $1 in this example, your reward will be £2, $2 or €2. And in our final example, if you risk £1, $1 or €1 and you hit take profit, your reward will be $3, £3 or €3. Now, why is this important? Well, as traders, we have a disadvantage because we're just retail traders in the market trading against the big boys. Who are the big boys? Well, the banks, the institutions, the hedge funds, the prop firms, whatever you want to call them, or whoever's out there. Anybody who has a lot more money than us has a little bit, or if not a massive advantage in the markets, especially with the information they have. Now, as traders, to gain an advantage, what we need to be doing is we need to be looking for things like confluence, which could be patterns, processes, following structure, looking at key levels, support and resistance, using tools like EMAs, Fibonacci's, whatever you want to use. These are things we use to increase our probability of winning our trades and being on the right side of the market. But we also know no matter what confluences we use, there is still a probability that we're going to lose trades. Now, this is where risk to reward ratio comes in. The higher the risk to reward ratio, the bigger the cushion you're going to have as a trader. Now, you may not understand that, but in simple forms, or in its simplest form, I really advocate 1 to 3 risk reward ratio, hands down, and I always have since I've started trading. But let's just imagine this. On Monday, you take a trade and you lose. On Tuesday, you take a trade and you lose. On Wednesday, you take a trade and you lose. And Thursday, you take a trade and you win. If you're using a 1-to-1 risk reward ratio, then that means by Wednesday, after losing 3 days in a row, you're now minus 3R. And if you win on Thursday, you only win 1, which means you're still minus 2R. So if you're playing the numbers game and working with probabilities here, a 1-to-1 risk to reward ratio would not favor you if you're trading on a daily, weekly or monthly basis in the long run. Now, it can for traders who are very experienced and take more than one trade a day and understand how to play the numbers, but for more inexperienced or traders who are still trying to find that consistency and profitability, 1-to-1 is going to be at a disadvantage for you. Skipping 1 to 2 here, let's go to 1 to 3. let's say you lose Monday, Tuesday and Wednesday, you're now minus 3R because you risked 1 and lost 3 days in a row. But if you win on Thursday, you now bring that account back to break even. So it only takes one trade to cover the loss of 3 trades, which gives you more of a cushion to not be a perfect trader. And in fact, we'll go on to the numbers in a minute, but with a 1-to-3 risk reward ratio, you can actually be 70% wrong and still be a very, very profitable trader. So have this in the back of your mind as we continue to go through some of the numbers here. But I just also want to lay it out there, or lay it down, before I get ripped to shreds in the comment section. If you're trading 1-to-1, it's completely fine. If you're trading 1-to-2, it's completely fine. And if you're trading 1-to-3, it is also completely fine. Ultimately, the aim as traders is to make money, and no matter what risk reward ratio you're trading or using, if you have a good system, you have a good concept, and you know how to remain disciplined and patient, then ultimately this 1-to-1 will lead to money. This 1-to-2 will lead to money, and this 1-to-3 will also lead to money. So let's take a look at some numbers here. So I want you to take a look at this chart here. As you can see, this is a risk reward ratio chart. Now, we spoke about in our previous example a 1-to-1 risk reward ratio. In order to be a profitable trader using a 1-to-1 risk reward ratio, you have to be 60% right in order to make money. That means out of every 10 trades you take, 6 of them need to win and only 4 can lose for you to make money. Even if you are 50% right, which is a huge, huge ratio in trading, that means you will only end your trading session, week, month or year as a break-even trader. You can see you would not be profitable at a 20% win rate or a 30% win rate or a 40% win rate, which simply means there is not enough cushion here for you to have the confidence to trade consistently over a period of time without having the fear of being wrong almost every single trade you take, or at least 50% of them. Now, if you move over to 1-to-2, all right, you can be a 40% win rate trader and you can make a lot of money, which is absolutely fine here. And I advocate this. Not many traders can go for 1-to-3 because by the time price moves to 1-to-2, guess what? Price turns around and takes you out break even. You might find some support or resistance that price can't break through. So 1-to-2 is an absolutely amazing risk to reward ratio here. But as you can see, you have to be more than 30% right. In fact, you can be 35% right here, have a 35% strike rate and still make money. But the point is, there is a lot more cushion here at 1-to-2 than there is here at 1-to-1. But you still have some boundaries or barriers that you'll be facing as a 1-to-2 trader. Now, if we move on to 1-to-3, which is what I advocate, and I'm not saying this so that I can convert you to do otherwise, but I'm just saying, even if you are 30% right here, guess what? You will make money. And this is the beauty of being a trader. We play the probabilities game. We're never going to be perfect. We're never going to get all our trades right. We're never going to take profits all day long. In some scenarios, we're going to hit a 1-to-1, a 1-to-2, and a 1-to-3. But if you can focus your attention on a high probability risk to reward ratio target, then you would increase the odds of you becoming profitable in the long run. Now we can start moving on here to 4-to-1 and 5-to-1, but that becomes a bit long-winded, and I think those that are still trying to find or seek that consistency in their trading, stick to 1-to-3 or 1-to-2 at bare minimum. Once you become more confident and you can recognize your patterns and you start to become more consistent and you know the scenarios where you can target bigger trades and rewards, etc., then worry about 1-to-4s and 1-to-5s. But for now, I want you to just focus on 1-to-3. Now, obviously, the higher the risk to reward ratio you have, the fewer trades you need to win, but that also comes with some drawback as well, because the less trades you win, the more likely you're going to become discouraged. You're going to start to revenge trade and chase the markets, because eventually you're going to need a trade to validate that you're a good trader. So stick to the 1 to 3s, 1 to 2s at bare minimum. Leave the 1 to 1s alone and stop going for those big targets. Find a middle ground, be a 30% win rate trader, win 3 out of 10, and you're still laughing all the way to the bank. So now this moves me on to the second question that really ties nicely with what we're talking about today. Rocks, how do I know when to go for a 1 to 1 or a 1 to 2 or a 1 to 3? Should I go for a 1 to 3 every single time? What should I do? Well, let me give you some things to think about. Let's move on to our first example. So let's take a look at pound USD, and guess what, everybody? Rocks is on the replay mode again. But remember, when you come and watch my videos, I'm here to teach you principles and concepts. If you want to learn, listen clearly. If you don't want to learn and you want to be picking at everything I'm doing, then just go and watch somebody else. There's many out there. Rocks, what target should I go for? Should I go for a 1 to 3 every single time, or should I switch it up? Well, let me give you some guidelines here that you can work with. We're looking at the structure of this market. We can clearly see that the market is making lower lows and lower highs. We also can see here in the market where price is creating a key level and price is failing to break above. We have multiple wick rejections here to indicate bullish sentiment. Bulls are failing, bears are stepping in, and we have really nice momentum shift here and here. It's not incorrect to take this trade simply because price is now starting to break below some key levels here. For the first time in a very long time, price has finally broken close below this level. I'm not saying this is the greatest of entries, but I'm trying to give you an illustration of how you can decide what risk to reward ratio to go for in different situations. Now, let's say I want to take this trade. The best place for me to take this trade, if I plan to take it, is always going to be at the break of a key level or a retest of a key level. The best place for me to place my stop loss in a situation like this is always going to be above the previous low high or higher low. Now, you can place your stop loss here above the candle that broke out, but remember in our previous videos, there is a very high chance price can pull back for a potential double top before it continues down, resulting in you being stopped out and the markets then going in your direction. So to be safe but sorry here, we're going to place our stop loss above the level where it should be, which is the lower high in the situation. And now we need to decide how we're going for our targets. Now let's say you're a 1 to 3 risk reward ratio trader. If you're going for a 1 to 3 risk reward ratio, look at the targets here. It's absolutely humongous. And realistically, it's very unlikely that you're going to hit targets in the time span that you want to hit it, or the markets might find some sort of bottom and then start reversing and pulling back up. So what we need to do in a situation like this is we need to say to ourselves, well, right, I'm a 1 to 3 risk reward ratio trader, but it's okay from time to time, if need be, to evaluate the situation and say to myself, well, look, there's a level here in the market where price will find some resistance. This is a traffic area where price could come to and bounce off before going up. Now, it's much better that you decide to take your rewards here at this stage, knowing a few things. Firstly, the fact that you're entering this trade pretty late. Secondly, you have a very big stop loss, very unusual to what you're used to taking. And then finally, there's an area in the market where price could potentially bounce off and reverse to take you out at break even, or potentially reverse and continue up. So evaluating this trade and identifying that it's not the best of opportunities, but an opportunity you want to take, you can say to yourself on this occasion, I'm going for a 1 to 1 risk reward ratio, and then I'll wait for another opportunity or a better opportunity to target something much greater. So you take the trade and the market moves in your direction. Now, this is not how it always plays out, and I can promise you all, it takes me absolutely forever to look for examples, but the example that I would have loved to show you right now is identifying candles trying to break through the structure and failing, leaving wick rejections and also closing with bullish candles. I don't necessarily want to see it break through like this in this example, but I'm sure you can follow me. If price starts to fail to break below, then guess what? Close it out at 1-to-1, take your profits and walk away. Remember what we said in the beginning, we're here to make money. And that's our ultimate aim. So this is example number 1, and this is a scenario you can think about for the future. Let's take a look at example number 2 here on Euro Yen. Now we're looking at the structure of this market, and I'm looking at the immediate behavior here where price is creating a huge wick rejection with a bearish close. We line this up with our added confluence, which is a key level where price has created a rejection, a bearish movement, and price has come back to retest that level. Now we classify this as a potential double top. It may not be your textbook trade, but I need you to understand why we're taking this. We enter this with an instant execution in the hope that the market will continue down at this stage. But remember what we said on our previous example. We have an area here in the market where price potentially could find traffic after leaving this zone. So what do we need to do? Well, we need to make an informed decision how we take our rewards. Now, if we're a 1-to-3 risk reward ratio trader, we'll be targeting somewhere down here, which may not be feasible. But if you can see here, we have an area in the market where price is rejected before, and it seems more feasible in this situation to go for a 1-to-2 because there is a very high chance price could find some traffic at this level. So we take a decision, or we make a decision based on the structure of the market and say to ourselves, well, there's a lot of traffic here, multiple wick rejections, a huge reaction previously when the candle was bearish. On this occasion, and just on this occasion, I decide that I'm going to go for a 1-to-2 risk reward ratio trade. So we enter the trade and we take it like so. Now again, what I want to illustrate to you is that if the markets get to these levels and you start to see multiple wick rejections and you can see that the market's not breaking it and you have some bullish candles, make an informed decision to close out at 1-to-2 or set your TPs there until you find a trade where you see the markets moving in your direction or less traffic to the left. Let's take a look at our third and final example. Our third and final example here is on USDJPY or USDJPY. Now you can clearly see that the trend in the market is down. We're making really nice lower highs, lower lows, and you can clearly see that the market is respecting this bearish movement. We have a pattern here to validate why we might want to take a trade with multiple wick rejections and a double top. And we also have a momentum shift here in the market where price has created this really strong bearish move to the downside. Based on the downtrend, what we expect the market to do is make a lower high and then eventually make a new lower low. So at this stage, we can argue that price may not break this level. But comparable to the last two examples, what we do understand is that this structure is the cleanest of the three. So what we are expecting this market to do is eventually make this lower low. Based on that information, with this big bearish engulfing candle, if we decide to take this trade, we can place our stop loss above structure. And in this instance, because we know the lower low is going to be made, we can target our 1-to-3 risk reward ratio trade. Now, why can we target a 1-to-3 risk reward ratio trade in this scenario? Well, if you look at our targets and where we're planning to enter this trade, look to the left. There's no traffic. And that means that there's a very high chance that price can continue down without any problems. Whereas if there was multiple wick rejections over here and here and here and consolidations and key levels where price is failing to break, then there'll be a much higher chance that this price will fail to push down. But based on the clear trend, based on the fact that a lower high will eventually in a downtrend make a lower low, we can take this trade confidently, target a 1-to-3 risk reward ratio trade, and say to ourselves on this occasion, based on the simple fact that I have no traffic to the left here, we can go for our normal risk reward ratio trade. And those three scenarios are in my humble opinion, are the only scenarios where you need to make those judgment calls. And I really do hope that this can help you out. So that's it from me. I hope you enjoyed that video. See what you think of it, go through it again, play with your numbers, look at your past data, see what really works for you. I'm not saying there's a wrong or right way to do this, but I'm just telling you now, I think that there is a better way to do this just to give yourself a better advantage to hitting those take profits. So as I always say, if you've enjoyed this video, smash that like button for me, guys and ladies, turn on notifications, subscribe if you haven't, and until next time, continue to trust the process.